Hello, my name is David. Welcome to this demonstration when we're looking at the depreciation what-if analysis. In this demo, we'll use the what-if analysis to forecast depreciation for groups of assets in different scenarios. So let's go over to the system. Here I've logged on the system with the job role of asset accountant. Double click the asset work area, gets me to the asset landing bench. After the task, perform a what if analysis. Remember, this is purely analysis. It has no impact of any calculations or depreciation in any of your books. So let's leave it in Supremo US Corp. Let's say we want the analysis from July 20, based on the two currencies, either US dollar or the reporting currency with the conversion rates, let's say US dollars. Perhaps we want to look at the impact of the next 12 accounting periods, which in our case is 12 months. Notice you can either do this on a hypothetical asset, or you can pick one of the assets in your particular asset book. So let's look for one of our assets in the asset book. And I'm going to pick top of the list on this equipment fitness. Currently that's straight line, 6,000 over 5 years. So it's $100 a month is what should be the depreciation. So again, I can narrow down my search on any of the parameters. Let's now say, well, what are we going to compare that? Here it shows you all the seeded different or depreciation methods, shall I say, and you can add your own as well. So what I'm going to look in here is for my modified accelerated cost recovery. And use the wildcard. These, I think, are the accepted practice when you're looking at public sector in the USA. Then, obviously, with my accent, they're not used widely here in the UK, but Her Majesty's Revenue and Customs have our own different depreciation methods used for tax books or corporate reporting. So let's pick on this one, which should be the more extreme in terms of a half-year convention with a 50% bonus. And so, okay. And life in years, well, let's compare it with the straight line. And we might have some depreciation bonus rules. We might want to change the prorate convention. If there's changes, we might want to amortize the changes, but I'm not going to do any of those, and I'm going to submit. And it then tells you that will run in the background in the ESS job to extract the data. You'll need to go in, as it says, to run the what-if depreciation analysis report from the scheduled processes to see the outcome. So from my scheduled processes, I found the report, which is this what-if depreciation analysis report, selected the parameter of my book, and I've picked up the latest process ID. You have an option to delete the data as you run the report, but I've left mine as no, and I'm submitting that report to the ESS processing schedule. The report has succeeded, so let's republish it in any one of the BI formats. So if you want to drop it into rich text Excel, I'm going to go for a PDF. So in terms of the output report, it repeats what you put in your analysis parameters. And it shows in terms of the depreciation charge, expense charge per period over the next 12 months. So as I say, I picked the one of my new assets, which is $100 depreciation a month. And you'll see the effect of switching it to that modified accelerated cost recovery system. So up until, in terms of December, significantly more depreciation. And then you'll see from that in terms of reduced depreciation. So that's quite common with the modified accelerated cost recovery system. There's more depreciation in early periods or early periods of the asset use, less in later life. Whereas the more straightforward, perhaps corporate straight line, is we'll have the same charge for the life of the asset. So very, very useful tool. Remember, you can use it on existing assets as well as hypothetical assets. So that concludes this short demonstration. Thanks for watching. Please move on to the other demos within this learning path.